morning to you, and welcome to On the Mark alongside Mark Pappa. I'm Gary Byron. Mark Pappa is the president of the Financial Resources Group. Financial Resources Group is out of Glastonbury. Of course, you can find them online at www.frplan.com. That's F as in Frank. frplan.com. More importantly, write this phone number down and do yourself a favor. It'll be the best thing that you have done for yourself, perhaps even for your family. Call it. I don't want you to miss any of the show. Of course, if you have to call right now, call right now. But I want you to, there's so much information that we receive from Mark Pappa on a weekly basis. If you can wait till the end of the show, all the better. The bottom line is that you call it 860-657-8380. One more time, 860-657-8380. And by the way, if you miss any of this show or any of the previous episodes, you can always go to that website that I gave to you, frplan.com, and you can listen to some of the previous shows. Mark, good morning. Great to see you.
Hey, good morning, Gary. How are you?
Boy, I tell you, not too shabby. How's your week?
So far, so good. I had a great week, and what a great weekend I had. It was probably one of the best weekends I've had in a long time. UConn, beating Duke in football.
I saw you.
Actually,
social
beautiful
media
weather,
posts, yeah.
60 degrees, great tailgate weather. I'm not sure, today's weather's going to be matching last week's, but a little bit colder. I know the temperatures have dropped a bit, so it's time to start putting our coats and sweatshirts on.
Yeah, it's going to rain tomorrow here.
It's actually feeling like November. So
that's okay.
We've gotten very lucky. We've had an Indian fall, so to speak, for lack of a better term. So it's been nice and warm and good stuff. So I can't complain. Everything is good.
I'm happy to hear that. I think we were talking last week, before we get into today's episode, let me say, you were talking about the seminars that you were doing. And I know you're going to suspend them for a little while till we get through the holiday season that you were having at Ruth Chris Steakhouse. Do you think come January you'll resume them again?
Oh, absolutely.
Okay.
The content, I actually cut it down, and I'm going to be modifying it some even more based on some excellent feedback from some of the people who've come in. The quality of the people coming in, a lot of the people, what makes it hard for me are actually still working. So what I am going to do is modify it to say I only want to deal with people coming in who are actually retired, or at very least one spouse is retired. It's too much to be, meeting people at 7 o'clock at night, and those days are behind me. I don't need to do that anymore. But
that's understandable.
And frankly, I can help them, but I can't really help them until they're fully retired.
Is it not, though, better to sit down with people before they're retired so that you can prep them for
here's
retirement?
the caveat. If you're going to be retiring within the next 6 months, come to the seminar. I'm happy to work with you. But what happens is you get to know people, then they forget things. You have to do the work 3, 4, 5 times just to get them engaged. And it just takes too long. In the process, it's not really an efficient process. But I can walk people through a lot of the fears they have in retirement and a lot of the, with this full checklist review. I mean, a lot of the things that they were worried about, we uncover a lot of other things that were never even done for them that they should be worried about. But it's not about making them worry. It's about uncovering the problem and showing them how to solve it.
It's a great
and also
point.
the motivation and why the problem exists in the first place. And the problem exists because their advisor's just not doing a good job. And their advisor's just actually leaning in towards taking care of themselves and not the client.
Right.
So we see that a lot, and most people don't even know it's being done to them. So that's what their full checklist review does. It finds benefits you road that you're not aware of. It will help you uncover little things that are easy peasy fixes, but need to be fixed because can throw you into a tailspin if they're not done. And more importantly, what we're going to do is we're going to see if that advisor that you're working with is actually being true to you, is actually showing you the different fees and costs. And we're going to be, taking a break from the full checklist this week to talk about some, I think, more important issues in the short run. But we will be continuing that in the following episodes to talk about hidden fees, unnecessary costs, trading costs, why certain things were done, and anything that's done. If your advisor supposedly is a fiduciary or calls himself a fiduciary or even a quasi fiduciary, whatever they call themselves, that they should be acting in your best interest in all times, not just when it's convenient.
All right, so today we're going to dive into the heart of really what's driving Wall Street and potentially setting it up for a fall. You know, the AI boom has been really the story of the year, pushing the S&P 500 to record highs. But it is all really, is it smoke and mirrors? Mark, just kind of curious about that.
Well, I mean, I'm not here to call a bubble or a crash anytime soon, but I do want to highlight some potential cracks in the armor. Even, what really gave me this idea to talk about this, just even going back, I was at the conference, Astoria Advisors Conference, their global macro conference about 3 weeks ago. And, in October, and here I was in a room of, some of the smartest people on Wall Street. I mean, some really high-end people. And we're talking about this potential bubble. No one's ready to call it a bubble yet because, I think the bubble's blowing up. But at the same time, you have to be involved in the AI trade. But the other side of it is you also have to be cautious of the AI trade. So my goal today is to get people to know that if you're just in the S&P 500, or most of your portfolios that I see, a lot of people's portfolios are tilted to the S&P 500 and tilted to growth in the S&P 500. You run the risk of having, most of your company, 37% of the S&P 500 is in tech stocks. And you're have a high exposure to the Magnificent Seven. And if there's a sneeze in this sector, which we just saw recently, we're going to go through some of those things, a little bit of a hiccup here, there's a lot of downside where that, to this market too, if you're not careful, or things start to become unwound a little bit, or people are, and we're going to go over, people are starting to question, how achievable is these big giant goals and these big announcements that are being made, and let's see that now. It's time to get past the hype and see through the dust and see the data center being built and what is actually being done, or is there any opposition from locals to someone building something the size of 10 football fields in their backyard, sucking up all their power, so they're getting brownouts. You know what I mean? Like, let's look at what I'm here to do today is let's talk about the reality of this trade.
All right, so let's unpack some of those warning signs then, right?
Yeah, absolutely.
Yeah, Michael Burry, the big short guy who's been right more times than wrong, dropped a bombshell tweet just last week. He called out hyperscalers like Oracle and Meta for understating depreciation on their AI assets. So what's the story there, and why does it even matter?
I know. Let's dive into this. So let's break this down into small bites.
All right.
Michael Burry obviously was the Big Short. If you saw the Big Short, he was the one that saw the weakness in the mortgage market. He saw that the incomes, weren't there to support the mortgages. He was there to see that these mortgages were written very loose with very loose terms. And obviously, what's happening back then is. And if you look at the peak of the S&P 500 in 2007 was mostly financial companies, okay, along with ExxonMobil and GE, but it was mostly financial companies. They were writing mortgages, and they were doing these things called securitizations, selling off the mortgages to the public and to pension funds and to banks, and then banks were buying them and levering those up because they were considered safe, and they were, they had credit insurance, and it was all great till everyone went bankrupt, till there was that massive bailout. So he's the one who called that. He shorted that market, made billions of dollars for himself, and he stayed in that short because everyone thought he was crazy to say, how are you, fighting against something that is so pristine? And he turned out to be right, along with some other very, very smart people. So basically what he's saying at this stage of the game, he shorted a good percentage of his portfolio was to buy put options on NVIDIA and put options against Palantir, which are both very high-flying and very well-run companies, by the way, very profitable companies of the AI boom. What he was doing with the buy a put option, it's the right to buy a stock at a lower price. So you're betting the stock's going to go down. And if the stock goes down, the put option goes up in value. Real simple. It's protection.
Okay.
That's like an insurance policy.
Sure.
If the stock goes up and continues to go up and up and up, then you erode the value of your put option and you could lose your money, right? So that's how it works. But he's basically betting that they were going to come down. I think in the short run, he caused some stir. Probably he's made some profit. Maybe he's taken some profits. I don't know. But he's also talking about the depreciation aspect of this. So in accounting, guys, and again, I don't want to get too technical because we're on the radio, but in accounting, depreciation is a non-cash expense that allocates the cost of a tangible asset like machinery, buildings, or servers, right? Big part of the AI, or chips, over its estimated useful life. This spreads the asset's price as an expense on the income statement, reducing taxable income and reflecting wear and tear. So let's face it, these chips, these computer chips, you buy them, they are going to wear out eventually, right? They're going to be running these things 24/7, 7 days a week, right? That's what robots do. That's why we want robots and AI. So what basically Burry is saying is understating depreciation by extending the useful life of the asset artificially. So if I could write something off in 3 years, but I'm expending it to 5 years, that's going to inflate my earnings. So it should be written off in 3. That'll hurt my profits. If it's written off at 5, it makes me look more profitable because my expenses are lower. See what I'm saying?
Yeah.
So understanding extending useful life of assets artificially boosting earnings, one of the more common frauds of the modern era. This is Michael Burry's tweet. And massively ramping CapEx through purchase of NVIDIA chip servers on a 2 to 3 year product cycle should not result in the extension of useful lives of the compute equipment. Now, I've been doing taxes a long time, Gary. My only other argument as to why they would be extending the depreciation could be, Ken, I'm not a CPA, but it could be that there's a glut in the market to where they haven't been able to deploy these chips into the servers yet. So a lot of these chips are sitting in a warehouse somewhere because you can't really depreciate an asset that's not put into use yet, right? So let's say I had a vehicle and I bought it in 2025 and I worked for a W-2 company, and then I started a business in the following year. I can't depreciate that car in the year I'm a W-2 employee. I have to wait till I put it to work as an independent contractor. Then I can start writing things off. So I think that he could be a little bit too critical on this.
Okay.
He could be grabbing at some straws, but this is exactly what all the hyperscalers have done, according to Burry. And his estimates will underestimate depreciation by about $176 billion between 26 and 28. 2026 to 2028. That's a lot of equity, my friend. That's a lot of money that could be used to spend on more data centers. So that's what he's trying to say. So he's trying to find a crack in the armor here. And then he says by 2020, they're 2028, I'm reading right from his tweet, Oracle will overstate earnings by 26.9%, Meta by 20.8%, et cetera. But it gets worse, more detail coming on November 25th, so stay tuned. So now when he has everybody on the edge of their seats to say, what is Michael Burry going to release on the 28th? So he's loading up on his shorts and hoping he can pop this bubble single-handedly. But the spend is so massive. So that includes the depreciation schedule of all the different companies and how in 2020, network compute depreciation useful life, every one of the companies, Meta, which is Facebook, Google, Oracle, Microsoft, Amazon, in 2020, they would do a 3-year. Oracle would do a 5-year, Microsoft 3. This is all GAAP accounting, so it's all standard stuff. It's all legitimate. However, if you push the envelope too much, Wall Street's going to catch you off guard. But now what's happening is in 2025, Meta used to write their chips off in 3 years, and now it's taking 5.5. Google 3, now it's 6. Oracle 5, now it's 6. Microsoft 3, now it's 6. And think about it, the OBBA just came out with bonus depreciation. You can take it all in 1 year if you wanted to. Why are they spreading it out? Because he's right. In a way, they're unfortunately looks like they could be overestimating their earnings. So he's starting to call some of the, he's starting to strap his boots on, if you know what I'm saying, Gary.
Oh, yeah. Well, OpenAI, Sam Altman has been rather vocal about the infrastructure arms race. He recently said OpenAI is on track for $20 billion in annual recurring revenue this year. Actually, that's pretty impressive for ChatGPT and all, but they're kind of locked into, a $1.4 trillion in data center commitments over the next, 8 years? That's a lot of power-hungry servers to feed. Altman even floated ideas about government support and then kind of backpedaled. So what's your take on this kind of mismatch?
That's another
here?
reason why I want to bring it up. Well, how many people knew who Sam Altman was even 3 years ago? mean, this guy's just stormed on the scene, right? When you watch CNBC, you listen to the radio, you listen to Jim Cramer, which I would caution people on recommendations, but from time to time he's a good commentator. He does have some good content. Nobody is right or wrong all the time, right? And but the interesting part is I'm not endorsing Jim Cramer by any measure, but I do have respect for the guy. And you hear Sam Altman, you hear Jensen Huang and NVIDIA. You hear these names get thrown around all the time. They're in the news constantly. They're being interviewed. They're, like the most important people in the world, for goodness sakes. And no one even knew who this guy was 3 years ago, right? Then we had 2022. We had a big rise in interest rates. We had the S&P 500 tank 20%, NASDAQ tanked about 30%, 30-year bonds down 30 with the rate hikes. But what happened in 2023 when we should have had a down year in 2023? The AI trade came about. ChatGPT came about. Microsoft, being a huge leader in investing in a ChatGPT. Right. So, I mean, this guy has just stormed onto the scene, and I'm just saying to myself, guys, it's time to take a breather from this guy, because here he is talking about, everything this guy says, everyone's just linking onto as if he's some genius. Now, who knows who he even is? I don't know who this guy is. Right? And let's think about it for a minute. Just because he says it's going to come true doesn't necessarily mean that's the case. He has $20 billion in revenue, which is enviable. Okay? He has a huge valuation on his business, but yet he wants to spend $1.4 trillion. So the main question is, how are you going to support a build out of $1.4 trillion when you only have $20 billion in revenue? You're going to fall a little bit short on that.
Well, they need to scale, wouldn't they?
They need to scale, but let's look at the big picture. You have $20 trillion to support $1.4 billion. It almost sounds like the United States government, right? Probably worse. It's a little bit pie in the sky, and that's common among people in the tech industry and the venture capital. They want you to be pie in the sky in your pitch. They know you're not being realistic, but they like the fact you're thinking that way.
Folks, you are listening to On the Mark. Along with Mark Pappa, I'm Gary Byron. Mark is the owner of Financial Resources Group. They're out of Glastonbury. You can find them online at frplan.com.
Oh.
And more importantly, their phone number is 860-657-8380. I will repeat all of that information more towards the end of the show.
I also want to bring up that government support part, because here he is saying, okay, $20 billion to spend $1.4 trillion. And it did float in his brain. He had a Freudian slip about talking about possible government support because we are in an arms race with the Chinese. Let's face it, the DeepSeek AI. And DeepSeek is making some major breakthroughs in terms of lower cost, less power, in their LLM, their large language learning models. They are making strides. So what happens if they make such a stride with the software that all of a sudden we don't need to build such big data centers anymore? What happens if that spend, or we don't need that many chips? What happens if that starts cracking and the forward-looking backlog of chips shrinks? This market's coming down.
And let's face it, data centers are huge, and they're expensive to run. You know how much water is used to run data centers just on a daily basis?
I can only guess how much that. I mean, you'd need to be near a river, probably. You'd need to be near a water source.
And then there's this web of financing that's got everyone buzzing. And what you might call the AI circular economy. Oracle's pouring tens of billions into NVIDIA chips to build these data centers for OpenAI, which in turn has a $300 billion deal with Oracle for capacity, partly funded by NVIDIA investments back into OpenAI. It's like they're passing the same dollar around the table. Although, is this buzzworthy innovation or a recipe for circular reasoning?
When I did the research on this, they're calling it circular finance. It's very creative.
Sounds it.
So it's like, okay, so I'm going to pay you. I'm going to do a contract with you. I'm going to buy a bunch of your chips. Then NVIDIA is going to put money into ChatGPT. Then ChatGPT is going to hire Oracle to, So it's definitely a cabal going on. It's a small world there. But again, all it takes is, Oracle has been borrowing a lot of money. So there's a lot of debt that they've taken on recently to do this. So you have to look and say, where are the potential liabilities? Do these guys overextend? Does it get overbuilt?
That's a good question.
And this is what happened in the 2000s, where 99% of all the fiber optics at one point in the ground was dark fiber. It was like a nuclear winter for fiber. Now all of a sudden, and now everyone says, well, that was, but now everyone's using the fiber and it's full at full capacity. However, it also took a NASDAQ to drop 75% during that period from, April 2000 to 2002, 18 months out the following year. And also took about 15 years for the NASDAQ to break even from that point. So it was an ugly, ugly time. So it's not to say that we can't see this again with what's happening now. The difference between us and now is that we have much more profitable companies. But in 2000, Microsoft was profitable. Oracle was profitable. A lot of the big companies that on this list didn't really even exist. Google was just getting started. ChatGPT wasn't even in existence. So that was a new company. Google and Oracle were there. Amazon was there, but Amazon was just building out its business model. It was very, very early in the game for them. Right. And they were reinvesting any money they made back into building Amazon. I mean, they built Amazon they didn't turn a profit for decades just because they just kept reinvesting and reinvesting to build the Amazon you see today. So it's an interesting difference. Right. But the companies are far more profitable than they were today. They have fortress-like balance sheets. They're as big as countries. So, but at the same time, it doesn't mean that they're impenetrable. Nothing is.
Fair point. So then what? To put this in perspective, let's talk valuations. Let's take Walmart, which is, listen, they've been a steady Eddie for decades. Historically, it took them, about 16 years for its stock to double from its early days. Yet in the last
this is interesting.
18 months, it's climbed from around $60 to over $103. That's a 72% gain, nearly doubling in the frothy market. JP Morgan, how about 12 years to double long term? And it's up 59% in the same stretch from $201 to $321. These are not AI darlings, by the way, but they're benefiting from the tide. So let me ask you.
This is interesting, yeah.
Does this make the AI surge look even more extreme by comparison?
Well, what I would say is I would take a ding on the S&P 500 because when you have the S&P 500 is market cap weighted.
Okay.
That means if you're the biggest component of the S&P 500, if I'm 7%, for every dollar that goes in, every $1,000, $70 is going in, $70 is going into one stock. 40% of the index is the top 10 companies in the index. So if you have $100, that means $40 going to the top 10. And as people dollar cost average into the market from their 401ks, from index funds, these companies are getting pumped up, okay, like crazy. So that said, this was interesting. I learned this just the other day from a good friend of mine at Market Desk Research, Jonathan Clements, who former Goldman Sachs analyst, and he started his own firm in 2020. We've been working with him ever since. We met a lot of great people during COVID, by the way. Everybody just started picking up the phone because everyone was like, oh, man, I can't be comfortable anymore. And we got some great connections. But Jonathan came up with this chart, one of them for Walmart's share price. And it's not just Mag 7 optimism, not going just Mag 7 companies, tech. So from 1992 to 1998, it took Walmart 7 years, to double. And then from 2000 to 2016, it took 18 years. Right? And then from 2017 to 2022, it took 7.
No.
And then most recently, 2024 to 2025, it only took 30 months for Walmart stock to double. Wow. That's insane. Now, Walmart's a humongous company.
Yeah, they are.
This isn't a small cap. Now, the same goes for JP Morgan. It took 136 months to double from 1992 to 2001. And then from 2003 to 2014, took 12 years for 146 months to double. And then we said 103 months to double from 2016 to 2023. This is JP Morgan. That's 9 years. So you have to wait 9 years to double your money. In 2023 to 2024, 22 months, JP Morgan stock's up 100%. So what does that tell you about the amount of money coming in? It's a very strong bull market, but do we have potential for downside? Do we have potential for this market to look a bit overvalued? And I would say, absolutely. I mean, now's not the time to sell out of the market. I'm not giving anyone that advice. Please don't take my advice. You need to talk to a licensed professional. I'm not, there's not an offer to buy or sell securities here, so I need to protect myself compliance-wise. But I do want to bring up some honest points about the valuation of this marketplace and that people need to protect their money. In order to protect their money, I think some of the smartest thing to do is to give us a call. Let us sit down with you, do a full checklist review. Let's look at your non-financial and your financial. Let's also take a look, though, at your portfolio. Let's stress test that portfolio. I can assure you, almost every portfolio I've seen from my seminar loaded up on the Mag 7. Every single one of them. Yeah. Very few of them were highly diversified away from it. Very, very concentrated in the S&P 500, but also very portfolios that were just, in 5 or 6 different funds, and they all owned the Mag 7. So they all had very high concentration risk, very high correlation, meaning if the market goes down and you're 100% correlated, you're very likely correlated, that means you're going down with the ship, right? And if the market's going up, well, great, everybody's giddy. Recency bias means the market's been going up. It's going to keep going. Let's be bullish, and we're happy. Let's pop the champagne.
They're expecting a bubble sometime soon, aren't they?
There's always going to look. There's a bubble. There's always going to be a bubble, Gary. And I'm telling you, during the COVID-19 crash, which was an anomaly, we saw a 34% drop in just 6 weeks. We saw very recently some of the panic that happened over tariffs. We saw how quickly the market can come down just on the tariff trade. So I think we're just a very fairly priced market. Very fairly priced market, and we need to be cautious. We need to figure out, where we're going to be balancing our portfolios, and again, stress testing that portfolio to see what your max drawdown is.
Folks, if you'd like more information on this topic or any of the others that we discussed on the show, maybe you've caught some things, maybe you've missed some things, head on over to www.frplan.com. F as in Frank, R plan, frplan.com. Stands, of course, for Financial Resources Group. By the way, Mark's office is in Glastonbury. That's where you can find Financial Resources Group. You know what I suggest, though? I suggest you calling him and sitting down with a no-obligation consultation. Could even get you a $100 gift card. 860-657-8380. Let me repeat that one more time for you. Right now would be the perfect time to call him. He is standing by his phone right now as we get ready to close off this show. 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.